Assalamualaikum and good day. My name is Aiman Ariff with Jasmin. Today I will be presenting on the topic of bottom-up pricing in room rates, specifically focusing on how this approach is used to determine room rates in the hospitality industry. You might ask, what is bottom-up pricing? Bottom-up pricing is a method that sets room rates based on the hotel actual cost and profit goals. It started from the bottom by calculating fixed and variable costs, adds the target profit, and uses this to determine the total revenue needed by the hotel. Hotels then forecast the number of rooms they expect to sell using the last year occupancy rate, room count, and operating days. Once room sales are forecasted, the total revenue is divided by the rooms sold to estimate the minimum room rate required to break even and reach the economic goal. You might ask, why is it important? Bottom-up pricing is important because it ensures that all business costs are covered and that pricing decisions are profit-focused. It avoids undercharging and helps maintain financial stability. It is particularly useful when operating under demand uncertainty, such as during post-pandemic recovery or low occupancy periods. In the hospitality industry, pricing mistakes can lead to losses, especially when profit margins are really tight. Bottom-up pricing is important because it provides financial clarity and control. It allows managers to know where much revenue they need to generate in order to break even and meet profit goals. To apply bottom-up approach, to start, the hotel needs to forecast how many rooms it expects to sell by using the last year data. For example, if the hotel has 100 rooms with 70 occupancy rate and operates 365 days a year, the number of rooms sold will be determined by multiplying the total rooms, which is 100 rooms, by the occupancy rate 0.7 for 70%, right? Then multiplying that result by the number of operating days, which is 365 days in a year, right? This gives them a figure like 25,550 rooms to be sold in that year to receive their target profit. Next, we calculate the pre-tax income. If the hotel wants a net income of, for example, 300,000 and the tax rate is 30%, we subtract the rate from 100, leaving 70% or 0.7. Then we divide the 300,000 net income by 0.7, the result is 428,571. This is the operating income before tax, which the hotel needs to achieve. Now, we add all cost components together. Assume fixed costs are RM 1.2 million, variable costs are RM 800,000 ringgit, and other operational expenses is 300,000 ringgit. Adding the pre-tax income previously, the total revenue required will be RM 2,728,571 ringgit. To find the average room rate, divide this total by the forecasted room, which is 25,550 rooms previously we calculated. The result is RM 106 ringgit 79 cents, the minimum rate needed per room to meet the financial target. While bottom-up pricing offers accuracy and financial controls, it also has some limitations. Most importantly, it does not consider market factors such as competitor pricing and customer willingness to pay. If the calculated price is too high compared to the market average, it could reduce the customer interest and affect the occupancy rate, which might affect the hotel to achieve the profit goals. In conclusion, bottom-up pricing is a reliable method that helps hotels set room rates based on real financial needs. It provides a clear structure for cost recovery and profit planning. When used together with market-based strategies, these strategies consider external factors like competitor pricing, customer demand, and price sensitivity. It becomes a powerful tool for financial decision making in the today's competitive hospitality industry. This balance keeps the increase of occupancy, boosts revenue, and maintain profitability in the real world condition. That's all for me. Thank you.